Crude oil hit a 26-month high earlier in the week as it seems to be marching back towards that $100 a barrel mark. Prices are up nearly 20% in 3 months, and that's pushing retail gas prices higher, too. Contributing to that rise, they're up 26 cents over the same time period. So what's the outlook for deal-making in oil and the energy sector? Tom Petrie is vice chairman of Bank of America and a veteran energy industry deal-maker. He's here with us in business. Thanks for coming in, Tom.
Good to be here.
So you are projecting oil in $100 range within the next year.
The forces are lining up that'll take us very close to that, if not through it, yes. Fear of QE2, still pretty impressive growth in both China and India. And now the tax deal all push toward higher prices.
You know, last time we got up to those triple-digit areas in terms of pricing, there was a lot of talk about speculators and, you know, the pricing not being aligned with fundamentals. But when you're talking about emerging markets, you're saying the demand is certainly there. Those
are the fundamentals that we're dealing with right now. If you get much beyond 100, 110, 120, we will hear again about speculators, and there'll be some element of truth perhaps to it, but the markets are trying to discount the forces that are at work, and QE2 in particular contributes to that.
So for those who say, you know, the kind of stimulus you may or may not get from the tax deal, payroll, tax holidays, all that takes the pressure off of the Fed to come out with a QE2 Part 2, Part 3.
Yep.
Do you buy that? I mean, does that in any way make you think maybe not 100, maybe a little bit under that?
It depends on just how the Fed reads that. That's true. To the degree that they back off from how aggressive they are on QE2, then there's a partial offset. But there's so many things at work here that, you know, the other thing we have to remember is we have a de facto moratorium for Gulf. In the first 12 to 18 months, 150,000 barrels a day of lost production in the Gulf of Mexico, probably twice to 3 times that over the next 3 years. That contributes to the tightening of supply demand.
You know, we had talked to so many local government leaders down in that area of this country who were concerned about rigs moving offshore and not coming back.
Right.
Is that a safe assumption at this point? And if so, where did that business go?
Well, there are other places in the world to drill. West Africa, parts of Asia.
They were the prime beneficiaries of this moratorium in the U.S.
Yep. Yeah, I mean, it's not wholesale. It's actually gone slower than we would have thought, but it is happening. And the longer we go without permits, permitting is running at half the rate being requested at the moment, according to the most recent numbers. If that continues, then it's going to put pressure for those rigs to move elsewhere.
And you don't see any near-term resolution?
Well, there's at least lip service being paid to the notion of trying to do it.
Well, certainly getting the jobs back online.
Yes, because there is a jobs impact, and the multiplier effect on the jobs impact is very real. It's not just the people on the crew. There's a whole lot of others in the overall supply and services pipeline that are affected by it.
Tom Petrie from Bank of America continues this conversation with us now. We've been talking about oil marching back towards $100 a barrel. What does this mean for deal making? Because you've been extremely active this year. I think in the league tables, B of A is in the top 5 in terms of activity. A lot of the acquirers have been foreign.
Yes, there is a definite foreign component, and there's 2 components to what people want to do, either joint ventures where they come in with a partner that's already here and get up the learning curve on these unconventional resource plays, or just conventional full acquisition of assets. It's asset rationalization and a desire to get into the major plays where there's real volume growth ahead.
And that's the Total, I think, was in the #1 spot in terms of most acquisitive in the year past. Do they keep up that pace? Does Petrobras also stay very active?
Well, some of it's driven by the overall path of the dollar. And to the degree there's dollar weakness that motivates them, that's a complicated call because there's so much going on in Europe with the euro that, you know, just extrapolating the dollar will stay weak is not necessarily a good bet. But I would say that's in terms of coming this way, but there's also a lot of transactions potentially developing in the international sphere as well. So I see it as a reorienting and a rebalancing of ownership of reserves in a variety of places around the world.
We spoke earlier this morning with the energy minister from Mexico, and she was talking about Pemex and their plans as well to open up the fields there to private ownership. It's a big debate within Mexico. But it sounds like any of that is a few years off.
It is. There's still issues in Mexico about opening up to private sector development. Coming out of the 1937 constitutional provision against having private foreign ownership of their reserves, that has been in place, and removing it is a big obstacle. So there's a problem in the U.S. We certainly are seeing a stretch out with a de facto moratorium. De facto in the sense that officially the moratorium was lifted, but the capacity to review the safety procedures and issue permits, the capacity to do that is lagging behind the need to do that.
So the production potential is here, in this hemisphere, in the Gulf, but the activity you see when you're talking about cross-border, where are you seeing that drilling and production pick up? Where are the opportunities?
Well, the North Sea has become a more mature province, so there's going to be opportunities in the North Sea and elsewhere in Europe. There's definitely opportunities in parts of Africa and Asia. And in North America, we're seeing all of the shale plays for shale gas and shale oil being very active. The Bakken up in North Dakota has seen 4 deals of better than $1 billion each in value here in the last month or two.
We didn't see a spill bill in the year past. We didn't really see major energy reform. I mean, in the new Congress in the next 2 years, do you expect any kind of regulatory legislative changes that will complicate some of those opportunities?
The co-chairman of the task force looking over the BP spill is coming out today, I believe, and recommending an extensive change, even an institute that's independent to oversee safety. So I think we will see something. It may be how much enabling legislation there'll be versus executive orders may be the question. I'm not sure we need another 2,000-page bill to make this right. There's an agreement on what best practices are, and enforcing that the pursuit of best practices by the industry participants is the order of the day. So that falls more in the administration's camp, I think, than more laws that don't get read.
And the low cost of natural gas, I mean, how is that going to impact in 2011 some of the opportunities in Marcellus Shale and the rest? Great question.
If oil's drifting from 88 to 90 to 95 and 100, here we have gas at around 4.
Right.
That's a historic disconnect. But the challenge is the new technologies have been so good that there are a number of different plays in the U.S. where good wells can be drilled with very good returns at $4, and that'll probably be the main driver. If we go to 100, I think there'll be some pulling effect on gas, but not a huge one.
Not a huge one. Well,
4 becomes 5, not 8.
All right. Well, we'll watch all that in the year to come. Tom, thanks for coming in and giving us your forecast.